Well, the economy is looking up, and if you watch what Fitch had done just a fair few days ago, if you are in government, you are happy. But the question needs to be asked, can this momentum hold? But there's no doubt it's good news for Ghana because we were in really dire times a short few years back. Currently, we are talking about an upgrade to B-, which is great news for those of us in watching the economy. We're feeling it in our pockets over the last few years, but also for the government as far as an ability to go back into the market is concerned. This is, are you credit worthy, for example? It is a very important question. Every government, including the United States, they borrow. You have to go out there and look for people who want to give you money. And your credit worthiness is a very important consideration for investors who have money to give out. If they actually assess you and come to the conclusion that it's risky to give you money, it's going to cost you far more. And that is where we've been for a long time. And that is where ratings such as you have there in the background is absolutely important, because we cannot, we've shown over the years, just live on what we earn locally through the taxes, etc. We often have to go to the international markets and borrow. We've been locked out from the international capital market for a while. This, I guess, is the first indication yet that we can begin to look forward to going back into the international capital market. Or is it? I'm going to ask my guests to weigh in on that, about what this means. We are stable. What does that really mean? The word tells a story by itself. How do you keep that stable? But this, for me, was a fascinating thing, because if you look at Fitch and the downgrades that we've had all the way down, if you look at the years from B to, we stayed at B a bit, and then we came to B minus, triple C, CCC, RD. I mean, we had dropped to the lowest ebb, but in one stroke, we go all the way to B minus. Now, if you look closely on your screen, you will notice that we have actually skipped 3 different ratings levels all the way to B+. Something fundamentally is happening that explains this significant leap, because you probably expect, as other things will explain, that you possibly have to come to C first and then do a climb to double C and then triple C before you get to B-. But we are straight up to B-. That is good news. But what is explaining this? We'll get my guest to weigh in, for example. The question about what is attributing, what are the factors for this particular leap is obvious, because if you read the report, it says a few things. I just want to summarize the top 4 for you. There's also the question about declining debt levels, which is important. We've seen that. Projections say we can actually beat our debt-to-GDP ratio under the IMF program way before the prescribed date. Sustained build-up in international reserves is a great one. I'll look at the numbers, specifics very shortly. The debt restructuring is currently near completion. The previous government did great work there. This government had continued it. Inflation we've seen is on the decline. So all these have helped. And some of the specifics, just to look at to confirm for you, 54.1%, talking about inflation, is where we were. Scary, dizzying heights in 2022, just on the back of the COVID and everything else that was happening in the world at the time. We're now currently talking about 18.4%. So that is good, right? Part of the reason why we're where we are with the ratings. And then you look at your very important question about the gross international reserves, where we were in 2022 of $6.25 billion. We are now currently at $10.67 billion. Again, very important. And when this levels start drop, that's when governments begin to really worry. Your creditors will look at that also, and that will tighten up how much it's going to cost you to borrow. Debt to GDP, and another one that everybody else is watching very closely, used to be at 77.5, is currently at 55%. So that, again, is great news for the economy. Now, the key questions around some of the issues that we know, and we've dealt with this over the period here on PM Express, the subject of the CD miracle, the public debt slashed, as we see, by 150, and then you look at the Ghana's external financing gap, which, as you see there, is is currently also post-restructuring compared to the pre-restructuring era. It's also doing pretty well. So a lot of the indicators are trending in the positive. But then you look at the ratings over the period in 2022, 2023, all three major ratings agencies are downgraded us, right? And it was terrible at the time. I will show you what the previous government said at the time when this happened because of its potential to collapse this economy. Now we are seeing over the last few months that all three are back, giving us upgrades. Of course, the steepest, the most positive, the boldest of them all is the Fitch one we are talking about right now. But we've seen S&P also give us a triple C+, and then we've seen Moody's at CAA2. So this is obviously a good one. The key question I need to ask, because tonight I'm delighted that we're joined by the director at Fitch, Sovereign Ratings, responsible for Middle East and Africa, himself is on the show. What is your own projections going forward? Are we going to see further upgrades, possibly in the highs of the Bs, which is absolutely important. That was something we need to watch. Now, at the time when this was happening in 2022, 2023, we know that the government then began to fight the ratings agencies. So, Kenneth Riata himself at the time made this profound statement that it's time for Africa to have its own credit ratings agency, because what they said had a potential impact on your pocket, on the survival of this economy. The president himself was also very vociferous about that same subject. The difficulties in the economy were exacerbated by the reckless behavior of rating agencies that engaged in downgrade, shutting Ghana out of the capital market, and that has been a reality since then, right? So the previous government weren't happy. But the thing about ratings agencies I have noticed as far as the political space is concerned is when they begin to upgrade you, the government seems to be very, very happy. When they begin to downgrade you, you see a bit of concern expressed, as you saw with the presidents then. The key question now remains, yes, we are doing great. We have been upgraded. We need to sustain that. There are few things in the Fitch report, though, that actually gives indication that they have confidence, for example, that the primary surplus can be maintained over time. That is good. Many have looked at that, and the discipline that this current government has shown in the last few months, the finance minister obviously at the helm of that. Many look at him play on his name and say Atto is forcing. Key question is, how do you sustain this over time, right? So that this autonomics, if you like, begin to become something that is settled, even during an election period. We wait to see. But then you look at the projection as far as our return to the capital market that the IMF itself told us. So by estimates, we can't go to the international market. By IMF own estimate, not even this year, not even next year, 2027. But the government is very ambitious that they're looking to do so sometime later this year. And this obviously could pave the way for that. This upgrade could pave the way for that. The IMF says, for example, that they expect that 1 billion could be open to us in the international capital market in 2027, 2028. 1 billion now also in 2029 there. But other creditors could give us money way before that, right? And that there is also good news if you read the IMF reports. Now, how does it really work? You have the government on one side, you have the creditors on the other side. They have money, the government needs the money. So how do I determine who to give my money to? I have to go and open the Fitch document and check how are they rating Ghana. Okay, then if they do rate you positively and strongly, like a B minus, B plus, AAA, thereabout, then I'm deciding less risk associated with you, then maybe I can give you money. But if I see that is far more risky, I'm going to charge you far more, a head, a leg, a tail, an eye, just to give you that money. So the ratings agencies are absolutely critical to the survival of most economies. And no wonder you saw the president there raise questions in the previous administration. But the big question we must ask, can the momentum be sustained? But fundamentally, what does this mean for you? My guest will join me, and I'm looking forward to the authors of this particular report, the director of Middle East and Africa, Sovereign Ratings at Fitch himself is my guest. Kujo Ponkrumah is here, Professor Bokpeng is here, and we have the government rep on the matter of finance also with us. You don't want to go anywhere here on PM Express. PMS is always brought to you by Centex Sanks. It is strong, it is tough. It's also brought to you by Academic Times, Pepsodent Cavity Fighter Toothpaste. My guest joining me for a conversation tonight is Professor Bokwing. Professor Godfrey Bokwing is an economist of finance at the University of Ghana, joins me in the studio. Also joining me is Kojo Opon Nkrumah. He's a ranking member on the Economy and Development Committee, an MP for Ofuasia Yerebi. I'm also joined in the studio by Thomas Garrell, who is the Director, Middle East and Africa, Sovereign Ratings at Fitch. Grateful that he can join me. He joins us via Zoom. Thomas, thank you very much for agreeing to speak to us. And Sharif Mahmood Khalid is the Economic Policy Advisor at the Vice President's Office and is with me in the studio. I want to start with you, Thomas, if you don't mind, because you authored this particular report. A very important one in this for us. But in simple language, B-, what does that mean?
Thank you very much for the invitation. Well, first of all, I think it's important to emphasize that we decided to move Ghana out of default on this specific time based on our assessment that Ghana has normalized relations with a significant majority of creditors, of commercial creditors. Then we decided to upgrade from default from RD to, as you said, B-. This shows that there are still some weaknesses in Ghana's credit profile with some liquidity pressures that we still consider as being pretty much high. Typically, the interest to revenue ratio would be about 25 to 26% in 2025 and 2026. So that means that for any CD that the government raises in revenue, it spends 25 cents in interest payments, which is still high compared to its peers. Other weaknesses that we have identified typically in public finance management, Ghana has a record of weak public finance management that, concretely speaking, means that in election years, Ghana has a record of fiscal slippages. So these weaknesses that we have identified still weigh and together with other structural factors like relatively low GDP per capita. So these weaknesses still weigh on the rating of Ghana. So that's why we decided to assign Ghana a B- rating again. This is a significant step for Ghana being moved out of default.
And I noticed when I was explaining what you've done, we were at RD and we're falling all the way from B, maintained B, and it came to B+, CC, triple C, double CC, and RD. But we've jumped all the way from RD all the way to B+. If you're reading into that we are on the path to recovery is now setting and opens the door to return to the capital markets, would that be a fair conclusion to reach?
Well, not exactly. What that means is that we do not identify a path to default. When you are rated in the triple T and below range, that means that we, as a rating agency, do identify a credible and potentially rapid path to default. This is no longer the case in Ghana following the restructuring of the external debt that is still ongoing, but also following the restructuring of domestic debt in 2023 with the domestic debt exchange program. So given that we do not identify this credible path to default, and given that Ghana has, I mentioned the weaknesses, but Ghana also has some strengths in terms of rating. This is why we decided to assign a B-. Then, whether we do consider that Ghana will tomorrow get back to the international capital market, that's not the case. as long as Ghana is under the existing IMF program, Ghana will not issue on international capital markets, basically because of the conditions that are attached to the existing IMF program. But your initial presentation, you showed that potentially Ghana could get back to the international capital market in 2027. That's a possibility. The IMF program will be over. It's up to the administration of Ghana to decide whether it wants to extend the existing program, whether it wants a successor program. But technically speaking, Ghana could issue in 2027.
Okay, so let's start from there because, Prof, I want to take you on that last point he makes there. We know the government had already indicated to us that they're actually looking at possibly going back into the international capital markets. I believe he says later this year. I think last quarter, if I'm not mistaken, is what he had said. He says categorically that he doesn't see that as something that is realistic within the current framework. But with a B minus, should the government be feeling confident that they can?
Right path. And I believe that going to the market, there are several factors that you need to consider. But for now, they are making important steps. I think reopening the market from the domestic point of view is more critical. Okay. It's more, for me, that should be more of a priority than the international capital market. Because if you look at the way we have used the international capital market in shoring up our international reserves over the years, that reason is no longer relevant. So the rush to go for FX from the international capital market remains mute, given where our reserves are right now, and also the drive to build reserves. But I think more importantly, let's look at the domestic market. Let's extend the yield curve. That way, it gives us leverage. Because the idea is that this will be CD denominated. If you have to go to the international capital market, let's say towards the end of this year, or even next year, chances are that you could be paying something slightly higher, okay? And that is something that we should be mindful. Even though B minus is very good, it's still below investment grade, okay? So there's a potential that there could be default going forward. And we said it on your network here, somewhere early part of 2022, that normally once you declare a preemptive debt restructuring, it won't take you less than 4 years before the market will receive you favorably and all of. So it's about weighing them. So I think that there shouldn't be a rush necessary to go to the international capital market, but we should assess our options. And the domestic market should be an option. The domestic market we should prioritize. Address the I can see from the IMF supported program why 2027 is critical because of the maturity clustering of our debt from the way it's been restructured, both from the domestic and then the external. So once the market reopens from 2027, we'll be able to roll over those debts with minimal risk. Address the broader question then for me. How significant is this? I mean, the authors have explained, but for you, as an economist here in Ghana, you understand it, you know, the local dynamics better than most. How significant is this B minus upgrade? Oh, I think it's quite significant. In what terms exactly? In what aspects? Because if you look at where they had placed us, restricted default and the rest of them, and making this progress, and even if you look at the framework, the analytical pillars that Fitch uses in their rating, we had met some of them way back last year. Okay, so because if you look at almost 93% of the eligible debt for restructuring had been completed before the election and all of that, we're left with about 7%. So in terms of the risk from that perspective, I think government had met that. But I believe that they couldn't go ahead given the 2024 election and the possibility, and I think the author also explained that, the possibility of fiscal slippages. Yeah. And the provisional results we have seen confirms that. So because we're supposed to do primary surplus of 0.5%, which is the main anchor for fiscal consolidation, per the revised budget for 2024, provisionally we ended up doing 3.9%, right, negative. So what we have done, and which also gives comfort to the rating agencies and all of that, is that government essentially has used their 2025 budget to correct that. Okay, so from their targets, it may be difficult to achieve that also because we are not seeing the revenue envelope responding aggressively to some of the measures that government has put in place, even though the exchange rates gains has conferred some advantages on us from the macro side. There are also trade-offs that we need to manage. Well, I think that is quite good. Things are consolidating and reinforcing each other on the path of recovery, beyond the fact that the economy exists beyond just creditors. There are different stakeholders in this economy beyond people who lend to us. So to the extent that this is good, and the fact that we have also seen recovery. But you should also bear in mind that in the last 2 years, you will notice that our economy surprises us, right? And even the fund, the extent to which we miss targets, either positive or negative in itself, tells us that we need to be very careful the way we look at the data. If you look at the IMF forecast in terms of GDP and even our reserves, we did far better than what had been programmed. But of course, there are other instances where the variance is also quite wide.
I mean, Khalid, so when government saw this B- rating, what has been the talk in government as to, so what do we do with this? Are we now feeling a bit more bullish to take on some of the major challenges? Because you're not spending yet. I mean, and Prof had said this the whole of this year. And
Prof and I, we've agreed on the spending bit.
Okay.
Right? Once the budget is read, the market responds to the budget, whether you spend a penny or not, because the market knows what you're going to spend. Because you've done allocation, you've done appropriations, you know what you'll do. So Prof and I are on the same page as to whether spending has been done or not. And there's paper spending ongoing, and the market takes care of all of this. So for me, I wouldn't say the government is getting bullish. But you see, when we talk about the likes of Fitch, among other issues, we're talking about external ratings. So this is not for an internal market. Or this is not for the domestic market. This is for the external market, which we are not ready as of yet to even start, pushing through, because we believe in stabilizing the domestic market, right? Which is why we have internal controls as far as spending, overspending, right? Tightening the controls, reducing appointments, among other issues, which are all signals. But I thought you were going to ask from where we came from to this, right? If you look at these ratings, when we took office, right, remember that Prof mentioned that we started to make some gains thanks to the domestic debt exchange program, because the domestic debt exchange program did give some gains. And obviously that would have an impact on any ratings that are to come externally, because mind you, we had the Paris Club, we have China and other external debtors and internal debtors as well. So if you have all of this coming in, what it means is that artificially there would be some gains thanks to a domestic debt exchange program. Now, when we came, took over office, what happened? We committed, reactivated the sinking fund, committed to paying all of this. In Fitch terms, when you say you are B-, it means that you've improved in terms of your risk of defaulting on a debt payment. So if you've activated a sinking fund, right, which is an insurance measure to servicing most of these, and then you've committed to both external and domestic debt programs, invariably is going to improve. So you get where the impact is coming from. It's government's own commitment and initiative and program.
So that's why Thomas says that they're confident that there's no chance of debt
no chance of default, because we made strong commitments to that. And as I've always indicated, it started right off with the minister's vetting, where he made these commitments, started signaling to the market. The president's, trotting he made around the world, he made these commitments as well. And on a daily basis on the podium, he's preaching this. So, and I also say something that the market would watch. It's quite difficult in the history to have within the economic landscape where you have a central bank governor, you have a head of treasury, the finance minister, you have the head of executive, the person of the president, singing from the same hymn book as far as economic measures are concerned.
But that's what every government does.
Well, come on. But there are times when they want a finance minister not to spend, and he goes ahead to spend. A central bank is printing money. They don't want the money to be printed. It does happen. This time around, we're not having that. So it's meant to be the norm, but that has not been as far as our economy is concerned. And if that is happening, again, that is worthy of commendation as far as the Mahama Opoku-Agyeman enforcing economy is concerned, if you look at it from that perspective. So I think that a lot has been done, a lot has been injected in, and there's a whole lot of commitment and firm commitment and outlook as far as the economy. Because mind you, it's just to say B- with a sustainable positive outlook. So what it's looking at is that invariably there's a lot that is happening, and the outlook is good for the external market. Do we want to go there yet? I think there's a conversation Cabinet would have to take a decision on, and the Ministry of Finance as well.
Okay.
But the conversation as of now is that we have stability. And mind you, the interesting feature of this is that quite often than not, when most emerging market countries are given a B-, the currency is still struggling. This time around, we are the B- with positive gains as far as the currency is concerned, which is a very unique feature.
Okay, I'll ask Thomas how unique that is pretty shortly. Could you? So, from the opposition, government in waiting, what's your view on this?
Is that an election year?
Because
that's comforting.
I mean, because you got the wrong end of the ratings agency's stick over the last few years. I mean, as I said, the president, the finance minister, in fact, they were almost like an international tour rallying Africa to say, look, we need to start putting in place. I believe even the AU put in place measures to start an African ratings agency on the back. So when you saw B-, what was your first reaction?
To read the reasons. I mean, sometimes people read headlines without going into the details to understand the why. So when you see the headlines, you want to go into the reasons. I find it interesting that, my brother Sharif is talking about, the commitment and the Jenupoko Ajiman, Mahama forcing the economy. I was hoping that we were not going to, get into that space, because if you pay attention to the reasons that Fitch has advanced for this upgrade and this outlook, the reasons are very clear. The reasons are the fact that on the 19th of December in 2022, Ghana declared, first, a debt standstill, and second, started a program to restructure our debt. I think my brother was generous enough to mention that the tee-off was the domestic debt exchange program, and then you got to deal with the official credit committee. In fact, today in Parliament, I brought you a report. Today in Parliament, we have now approved in Parliament, at least at committee level, the OCC debt restructuring on that side of things. So it is very clear what is accounting for this one. 70, if I even look at the 10 reasons that the Fitch ratings gave, about 7 of them clearly deal with the debt structure, debt restructuring. And I think we have to be fair to those facts. But I don't think we're here to try and appropriate, who is the one to take a victory lap for this. I am hoping rather that we're going to be looking at what the numbers say on the radar and how as a country we'll learn the appropriate lessons to move forward. One of them is the fact that there are genuine, relevant concerns still about how the international credit ratings do their work. Yes, we got the short end of the stick at the time, and our leaders were speaking up about it. I was telling Professor Bokpin when we were getting ready to come in that those conversations are still very germane. Because with these same numbers, some other countries will be given better ratings than we are being given. And if you go to the market with these ratings to seek to borrow, we're going to pay a higher risk premium because of the credit ratings that the international credit ratings.
Do I hear you say you expected a better rating than B-?
No. That's not what I'm saying. But I'm saying that the reason for which our leaders in the past complained about it is that even for the same fiscal parameters, you will find that they will score other jurisdictions better than they are scoring us. And that's what led to the call that maybe Africa should begin to look at its own credit ratings agencies. I was just explaining that. I think for me, the most important thing is where do we go from here? Because the reasons are clear. And how do we ensure that we don't get back into this same spot again? And it comes for me down to the issue of how we are managing our finances as a country. I mean, today, people confuse the failure to meet fiscal targets with fiscal discipline. You alluded to it, and my brother Sharif was mentioning that, we have agreed that even if we are not spending, the signaling effect is there. No, fiscal discipline is not a failure to meet the fiscal targets, i.e. the revenue targets and the expenditure targets, because they are not ends in themselves. They are means to an end. They deliver public goods and services. Yes, you want to ensure that at the end of the day, your fiscal balance is kept at the appropriate number, but you do that by meeting your revenue and expenditure targets. I dare say that today, if the government will be honest, they will tell you that they are beginning to face a few liquidity challenges themselves because the revenues are not coming in as they are expecting. As a result, they are not able to meet a lot of the expenditure commitments, which are necessary to deliver, at the end of the day, the growth, and the public goods and services, the jobs that you're looking for at the end. So where do we go from here? We have to ensure that we do better fiscal management in a manner that does not leave us with the kind of fiscal balances that we've had in the past that we haven't been very proud of. Not doing the better fiscal management and just sitting with a low balance at the end of the day is not exactly what we are all looking for. So I think this is good news for Ghana. We'll say kudos to the various officials who have taken decisions over the period. I'll go back, as far back as Minister Oforiatta, who on the 19th of December declared the debt standstill, who negotiated the big chunk of the, about 93 to 95% of the debt restructuring.
93%.
93% of the debt restructuring. And then Minister Amin and his team, who also came in to do some work to follow up. I'll give credit also to my brother Forson, who's come in and who is also continuing. And I don't think that we should delude ourselves that, this one should take credit and, it's because of the Genopoko. No, that's not what it is. There's clarity about what it is. But what we need to do is now moving forward, how do we ensure that we actually meet our fiscal targets? That's why I think that we should.
And just on that point about the discipline question, I see in the Fitch report that this very important indicator, all of you look at the primary surplus.
Yeah, the primary balance.
But the primary, yes.
Yeah.
And they are projecting that to remain 0.5% of GDP.
Yeah, whilst government had indicated in the 2025 budget that we will do 1.5%.
Yeah.
That's quite steep, given where it was at the end of 2024 and all of that. But yes, in as much I agree that if you look at the trajectory, particularly debt restructuring, a lot had been done before the new administration came in. But the positive outlook, the stability, the comfort that any rating agency will be bold enough to skip a lot of notes to arrive at B-, you can trace that to what the government is doing currently. Okay. And the complementarity between fiscal and monetary and all of that, that sends a strong signal to the market. And if you look at the expenditure cuts, right, in 2025, in nominal terms, it's more than 10 billion, right? And if you look at the reduction in the gross financing needs, okay, from 2024, it was around 61.4 billion Ghana cedis. We are looking at gross financing needs of around 44 billion. Okay, so that signals a certain kind of tightening and discipline going forward. I agree. So you see that from the revenue side, I indicated earlier that our revenue envelope has not responded aggressively to the measures that government has put in place. Remember that when you see that aggressive strengthening of the currency, whilst there are some advantages, there are also some trade-offs. And that is why over time in economics, we choose to treasure stability over these swings and the rest of them, because you may record some gains, but you may also record some losses here and there. But I think overall, government deserves some credit, because if you look at what they've done, I took also shock therapy and the rest of them, that gives confidence to the market. That tells you, and all of this has ensured that the macro numbers overall are trending in the right direction. So you look at what the stability from the currency, I even call it a disruption. Okay, so the president mentioned that we are saving in excess of 150 billion Ghana cedis, yes. So but of course, that is unrealized in nature until you are making payments and all of that. Okay, so we call that one theoretical gains and all of that. But if you put all of these things together, I think there is significant comfort for the rating agencies to upgrade us in the manner that they have done. And if you look at the outlook also, there isn't significant indication that default is imminent, okay, going forward. And I think that is quite good. Again, if you see how the growth has responded, okay, that is also quite good. But this also tells you that we are not out of the woods. The growth has been quite erratic, and we should all be concerned. When you see that growth is erratic like this, it tells you your economy doesn't have the resilience. So quarter growth can go to, let's say, 7.5. Then the following quarter, it comes to like 3.5, and then all of that. Because the understanding is that output volatility has implication for both consumption and income volatility. So we should be looking at a certain steady, predictable growth, which is based on some foundation that we have laid. And that is what I think the market is going for. Should we be asking that within this time, we could say it's too much of asking, but at least the measures have been put in place. And more importantly, how they reinforce each other. And then also how we navigate this austerity budget to more progressive spending going forward from 2026, 2027 will be very critical. Because as I've indicated, government is not operating optimally. And you can't run this same budget in 2026.
Inevitably, they'll have to spend.
But going forward, progressively. And I think we need to calibrate that.
No, but, you know, from where we've come from, as again, Prof and I have had this conversation several times, right? This is the best budget we could have for this year.
Agreed.
Right? So, which is a stability budget. It's not an aggressive spending budget, right? But even though you'd have items like the big push, among other issues, which are big ticket items, this is a stability one. So you look at all of this. I mean, again, we are not apportioning blames whatsoever because we're looking at continuum in government, we're looking at stability among other issues. But if you've come from a domestic debt exchange program, you need to ask yourself, why did we even have that? We're having the conversation and contextualizing it as though having a domestic debt exchange program is a positive thing and a normality in economic management or public sector economic management. It is not. Right? It is a painful decision to make in any economy, more so when you touch blue chip investments, even such as pensions. So that was a very painful decision being made. So it is not a positive gain to even put in the mix of economic gains of a country because we came at the heels of a domestic debt exchange program. So if we've come from that and we are in a B- status by an external credit rating agency, right, the government deserves massive commendation in what it's doing as far as handling the economy is concerned. Again, I don't think it's a very fair point to want to assess a government's revenue temperature by looking at first quarter, right? I mean, it's read its budget, it's a stability budget, it's first quarter. Can we allow it time to travel in? And also, yes, we ain't no government.
Have you seen signs that it will pick up?
Sorry?
Have you seen signs that it will pick up?
Of course, it's going to pick up. Because the point is, mind you, we've come from a very violent economy, right, which was tanked. So it's gaining surprises. And when it gains surprises to show that, okay, this is stability we're never expecting. These are currency indications with stability we're never expecting. These are market indications we're never expecting. Then people tend to be confused a bit to say, okay, well, can we wait a bit to see what's going to happen? Because it's not artificially controlled, it's demand and supply. All what is happening is the motivation, the internal control measures, and what the central bank, the government, and the executive or the treasury, by that the finance ministry, are doing to actually motivate that and incentivize the demand and supply to go on the positive side and sustainable side of the economy. And that's exactly what we do.
Stay with me. Let me bring in Thomas back in. He's the director of the Middle East and Africa Sovereign Ratings at Fitch. And Thomas, on that subject you've just been talking about with my panel in the studio, you acknowledge in your report fiscal consolidation, but also you highlight the projected primary balance of 0.5% of GDP in 2025. But the question that's just been tackling here, how confident is Fitch that the current government will maintain this discipline? And how does it factor into your ratings?
Yes, indeed. Our forecast is that the government will reach 0.4% of GDP primary surplus on a commitment basis this year. So that's a little bit lower than the government's target of 1.5%. But still, that's, as has been said in the studio, that's a significant improvement in terms of fiscal metrics compared with, for instance, a 4.8% GDP deficit, 4.8% of GDP deficit in 2021, 4.3% in 2022. So fiscal consolidation is still ongoing, and we consider that it will go on next year. You mentioned the 0.5% primary surplus that we forecast for this year, but we also forecast the 0.9% primary surplus next year. So this means that we're confident that the running measures that are implemented by this administration and the expenditure control that the government is trying to improve with the revision, for instance, of the Fiscal Responsibility Act will contribute to continued fiscal consolidation. Then, whether we are confident on the durability of this fiscal stance and prudent fiscal management Well, obviously, Ghana, again, has a record of large fiscal slippages on election year, and this scenario cannot be excluded. That is one of the reasons that explains the B minus rating, which is still in the lower end of the rating scale.
Except that, Thomas, we're still at least 3 years away before an election year. So we still have quite a bit of time. And I think I just heard you say that even for 2026, you were still expecting a primary surplus of 0.9%, correct?
Correct.
And so you were expecting that this discipline will continue into next year?
Yes, we do. Okay. We do. We actually consider that the government will manage to control commitments, to control cash payments in a better way compared with previously, based on, as I mentioned, the revision of the Fiscal Responsibility Act, on the revision of the procurement legislation that is a key weakness in public financial management. So the willingness to improve public finance management is here. Then we need to see proper implementation, and this is one of the triggers for a positive rating action that we have mentioned in the rating report.
I mean, Kojo, so from what he's just saying there, even the ratings agency, at least for Fitch, and I'll come back to ask him whether we can expect more further upgrades, because he's sounding very confident about this current government and the way they want to handle the economy going into next year. I know you are in opposition, yes, but you listen to Fitch say that how you reacting to it?
It's as if there will be proper implementation. Then these, optimistic forecasts that he's talking about will be born into reality. And I think the challenge every government faces is balancing your fiscal program with the real sector and the political economy. I mean, I look at my colleagues who are in government today, and they're very upbeat, and they're going on and on. And,
You've seen it all.
I've seen it all. You have to balance the fiscal program with the realities on the ground. And I'll give you a few examples. You see, first of all, if you're just looking at the forecasts and even the amendments to the rules as the basis for your confidence that, this is going to be aced at the end of the day, I'll tell you to take your time and think again. From 2017, that's when we brought the Fiscal Responsibility Act. You saw forecasts that suggested that if it was going to be properly implemented, we're going to have some outturns. There were two variables that had not been factored into those at the time. One was what you could not have expected to come hit you from somewhere, headwinds. And I don't want to go into the details, but already our colleagues are beginning to keep an eye on those headwinds. That's one of the challenges. Two is domestically, you've got a real sector that you have to deliver. You've got a social contract you have to deliver. You've got a political economy that you've got to try and respond to. So in one breath, you have a finance minister, you have a governor, you have the managers of the economy who want to fulfill a certain program on paper. And then on the other side, you'll find nurses on strike and, UTAG here, and you'll find...
No, UTAG, we are not on strike. I went to work.
You'll find labor unions okay, asking for something. And at the point as a government, you will begin to come to the middle point of reality. That is where usually governments have the challenge. So if I could give my colleagues some advice or feedback, I would say, don't just look at your program, but look at how you're going to balance that with managing the realities on the ground. For example, today, if you speak to the average chief executive or the average minister, they are beginning to get apprehensive about how the finance ministry is functioning. You notice our government, for example, has launched a number of programs to meet the 120-day timeline. Many of them, till today, have not been funded for them to actually start execution. It will get to a point where the political economy kicks in, and the people who have registered for these programs and the people who have voted for you are waiting that, where is this program? When is it coming? How am I benefiting? And you are looking at the numbers and you're saying 0.5%. That is where the rubber meets the road. And that is where you begin to find governments struggling. We don't wish them to struggle. It doesn't work well for Ghana if they struggle. But I think that instead of taking a victory lap, as I tried to explain earlier, the focus must be on how do we achieve this balance in a way that we deliver for people. This democracy has dividends for people, and at the same time, we don't break the bank or we don't compromise on the kind of fiscal discipline that we're. Is the middle point that governments have to strive to.
All right, I think exactly what we're doing, because if you look at this and what is happening as far as spending issues, among the issues are concerned, the internal control is very important as far as the economy. But then again, let's not have the erroneous impression out there as though we are celebrating. No, we're not celebrating. What we are invariably, or what has happened, is that an external force has responded to the internal control mechanisms and initiative that the local economy is doing. And that's exactly what Fitch has done. Our ratings agency is the people of Ghana. They decide, they feel. He who knows it feels it right. Right? The proof of the pudding is in the eating. And if the average Ghanaian is feeling that this is what it is, as far as the currency issues are concerned or stability is concerned, that's where it is. Today, as we speak, I mean, people who are earning forex in their accounts, I mean, will tell you that I have 30% haircut. And that's exactly what is happening. Now, again, you look at even spending, among other issues. It's quite an interesting thing. We have a very unstructured market as far as price controls are concerned. So invariably, we cannot move these gains to price control mechanisms. And that's something I think we all ought to be looking at regardless of government. Because you speak to industry, what they'll tell you is that they did their planning and scenario analysis based on the dollar pegged at 16 Ghana cedi to a dollar.
The national budget itself.
Right, yes, so 16 to a dollar. So what it means is that the end user or the recipient still is going to be burdened with it because of the lack of functionality of a price control mechanism. We have done our bit as a government as far as this is concerned. But then again, you have the likes of Passion Air, among other issues, or interesting businesses coming to the fore to say that, okay, as a measure of goodwill, we are going to do this. Right? All of this cumulatively reflecting some gains in the economy, as far as I'm concerned. So yes, there is something really happening. And the stability ought to be gradual, right? Because as I said, we've come from a very violent place as far as the economy is concerned. Not violent in the term as in very crude measures, but overheated, what I use it, because we needed to cool off before we even take a corner. But we took a corner before cooling off. And the cooling off effect is what we are having now. So we are taking the pain to actually cool off the economy, right, for it to return from where all of the indicators went south to normalcy. Then we can then have a proper running of an effective, optimal economy. And that's what exactly we're doing, and we're doing it very prudently. And with this, we would call on responsible opposition to join hands, because we are an inclusive government. We are not looking at it from a very partisan lens, but the people of Ghana is whom we are here to serve.
I mean, and I want to go back to Thomas. I'll come back to Prof later. The report, I noticed, warns of risks from new liquidity tensions, if you like, or confidence loss in debt refinancing. But I want to touch on a very important point and get your insights into that. What early warning metrics, if you like, should all of us watch to signal rising refinancing risk or FX reserve pressures? We know that has been a challenge in the past.
Yeah. Well, as I mentioned, the key liquidity risk that we identify is still elevated interest to revenue ratio. So far, we consider that the interest to revenue ratio will stabilize at 25.26%. But would this ratio increase, this would be analyzed as increased liquidity pressures, because basically that would mean that the government would run higher deficits and would potentially get back to a credible default path. So this interest to revenue ratio is a key metric to analyze liquidity pressures in the case of Ghana. Other items that we would consider typically is the inability of the government to reopen the bond market. The government so far in Ghana does not have elevated local currency denominated T-bonds that come to maturity. Just because basically the DDEP bonds start maturing in 2027. So the maturities on the T-bond market so far are very small at about 0.2% of GDP in 2025 and in 2026. But then you have to roll over all these bonds that come to maturity in 2027. And to do so, either you accumulate some deposits, and this is the intention of the government with the creation of the sinking fund, but we do consider that these deposits will not be sufficient to meet all these maturities. So either you draw down on these deposits or you roll over. That means you need to issue long-term again. And to do so, you need to anticipate. So you need to reopen the bond market either in 2025, which is our baseline scenario, or in 2026. Would the government of Ghana be unable to reopen the bond market? This would be analyzed as renewed liquidity tensions, renewed liquidity pressures. But so far, I think what is important to emphasize is that we consider that although this interest to revenue ratio is still high, the liquidity pressures are declining. And typically, we have seen a significant decline in the yields on the bill market. The government is not issuing T-bonds, so more than 1 year local currency bonds, but is obviously heavily relying on the T-bill market, so short-term debt. And the yields, whatever the maturity of these T-bills, whether it's 91 day up to 364 days, have dropped by about 1,000 basis points since the beginning of this year. So that means that rolling over these short-term debts costs less over time, and this contributes to a declining liquidity pressures.
I mean, Prof, what do you make of that?
I agree. Quite sound. And I also agree with Honorable Kojo Oponkrumah that if you see the platform that the government has created, I commend them, and I think it's the right way to go. But I think because we are also more, how do we future-proof this going forward? And I think that is where the challenge is. You will see that even in the 2025 budget, all government obligations have not been migrated onto the budget, totally, and all of that. But I think one thing that we should also bear in mind from the report is that whilst government says that they would achieve a primary balance of 1.5%, the report is saying we are not going to achieve that because there are challenges.
An implication of that is what if we fail to achieve that?
So the implication should be looked at more in terms of the IMF-supported program, because these are key targets, right? Structural targets, indicative targets, and all of that. My suspicion is that the fund may be looking at revising some of these targets and all of that. And I think it's something that they should do and all of that, because government is doing the possible best, okay? And therefore, we need to look at the dynamics and see that which works for us. Because typically, the IMF-supported program actually ends December this year. Okay, so 2026 budget, we don't need to bound ourselves so much. And I think also that is where the risk is. And you heard the director mentioning whether government is going to go for an extension or another program, or we are going to be on our own, and whether the internal structural reforms, like the fiscal council and all of that, will be well composed, and whether that can actually act as an internal fiscal restraint agent, similar to the fund would have done. So I believe that, yes, looking at their experience, because if you look at the economy 2017, 2018, we've had some of these things, but the idea is that how do you navigate the pressures as the election also approaches? And also, I've also indicated on your network that so far what government has done is to launch policies underlining the major programs that they want to implement. We are yet to back it with cash flow for the implementation. But there is also good news. That's how I see it. Given the refinancing space that we have until 2027 and all of that, government could be looking at infrastructure or asset-specific bonds rather than just borrowing to balance the budget going forward. And I believe that Listening to government, listening to the president and also the Minister of Finance, I think that they have a plan. I think that they are working towards that. Of course, there will be challenges here and there and all of that. We need to navigate that together and carry all stakeholders.
I mean,
Can I say something briefly about the interest revenue ratio problem that he was speaking about? And I go back to the point about meeting your fiscal targets. Fiscal targets are not an end in themselves. No government or finance minister enjoys putting up, these numbers as an end in themselves. Nobody chops these numbers. But they are supposed to aid you to deliver on the real issues on the ground. Now, this interest to revenue ratio warning that they are giving, that if we are not careful, the liquidity pressures could pick up again, I think is fundamentally premised on the revenue performance. Because for the interest forecast, based on the debt restructuring, it's been modeled. You have a clear idea what is going to happen. Secondly, thankfully, T-bill rates are also dropping, so the refinancing costs and pressures are also lowering. But if you don't get the revenue numbers where you have to get them to, the ratio will now begin to distort. And you see, one of the problems that governments have is, again, striking the balance between the number on paper and going down there actually to go and collect the money from various persons who must. We've had this conversation broadening the tax base and doing all of it too. What we should be looking out for, one of the first signals, is the mid-year revenue performance. It will begin to give us an indication whether or not all the ideas on paper are translating into, for me, one of the most significant indicators in the fiscal program, the revenue performance. Because the moment you are failing to meet those revenue numbers, something's got to give downstairs. Either your financing, it could have been a tidier financing program like he was talking about, but then you have to now begin to get out of it. Or if you are going to keep within that financing limit, which is preferable, then you are going to struggle on the expenditure side. And again, the expenditure side, like I've said, it's not just numbers, it's human beings, it's projects, it's lives, it's things you have committed to, it's the credibility of your government out there. So I think that one of the things that, Sharif, you guys need to keep an eye on is the revenue performance.
Oh, yes.
Because if that doesn't come in, if you look at the media numbers and they are not coming in, that's when you should start,
Yeah, sure.
Well, I don't see that as a disruption, as I said, because if you look at the planning with 16, right, to the cedi or to $1, it hasn't disrupted because of price control mechanisms. So what it still means is that the gauge of it, right, in terms of revenue projection, among other issues, if we tighten it a bit, would get us there. Mind you, I mean, we took...
Because now, sorry, I'm sorry to interrupt, because now you are losing, for every dollar you modeled, you are losing about, what, 4 cedis?
Right, but that's modeling. But most of the revenue being generated is in local currency, if you look at it from
yes, but at least on your external revenue
right, but
side,
external,
you're
yes,
losing that.
We're losing
that's why
that.
you're
But
trying to get
again,
6 billion.
Yes, but then again, port.
Yes.
And if we're trying to pay or to service externally, we'd also be, having a gain. So it's about how we strike the balance.
If we had opportunity of front loading.
Of front loading. That's what we serve again. But that does not say we're not going to front load. But I'm just saying that there are positive gains. That's why you run an economy, regardless of whatever it is. And you look at interest rate, inflation, among other issues. So mind you, at the time we were even coming in, there was no financial headroom to even do anything. So clearing off that financial headroom in and of itself is creating a healthy economic space, right, which could allow other investments to come in and to build the economy. So mind you, it comes from different sources. So our duty as a government, from what we inherited, is to create that financial headroom, to create the stability as far as economy is concerned, to create that enabling environment as far as the economy is concerned, and to allow Ghanaians...
And for me, that is where I commend Ato.
Yes, and that commendation ought to go. And that's that we are on course.
Ato is forcing.
Ato is really forcing on that.
With that, we are on course. But as I said, again, let me repeat on this channel that, look, yes, whatever we are doing, the response of it to the rating agencies is external, but an average Ghanaian is our real ratings agency. And
I'm looking forward to asking Thomas when we return from the break, should we expect further positive upgrades, if you like? Even I suppose upgrade is positive already, but something closer to B, and possibly even something in that area. Okay, so when we return, I'll ask Thomas that whether we can expect that,
yes,
and then also ask him what concrete thresholds would he be looking at in terms of considering further upgrades for Ghana going forward. But Kojo Pokruma started this conversation. When I return, I'll get back to what do we need to do to sustain the gains, to keep this momentum. He's already given government the benefit of the experience, right? He's touched on the revenue already. What else should this government be doing to maintain this momentum, to give Thomas and his team at Fitch the confidence to give us further upgrades? Stay with me after this. And thank you for staying with us. We're just about wrapping up this very important conversation. It's about your future and mine as well, as far as the economy is concerned. And we need to have this conversation because of where we are coming from. And when you hear a positive rating, it's a big deal, obviously, and we've been analyzing it. But how do you maintain this momentum is what we're going to do next. But I'm happy that we have Thomas Garriott, who is the Director of Middle East and Africa, Sovereign Ratings at Fitch. They put up this report with an upgrade that we've been talking about. In the studio with me, you know him, Professor Godfrey Bokwe, is an economist, professor of finance, and he's joining me in the studio for this conversation. You have Kojo Nkrumah, you know him. He is a former Works and Housing Minister, but he's currently the ranking member, Economy and Development Committee, MP for Ofuasia Yerebi. And of course, you have representing the government in the studio, Sharif, who has agreed to join us also, Sharif Mohammed Khalid, who is an economic policy advisor at the Vice President's office. And Thomas, to you now, as we wrap up the conversation, your rating, of course, is one that has generated a lot of conversation, but should we expect, based on your own projections, can we realistically expect further upgrades?
Yeah, the rating report mentions what we call positive sensitivities. So what needs to be met to trigger a positive rating action. And in the case of Ghana, we have identified 3 positive sensitivities. The first 2 of them are related to public finance and 1 is related to external finance. So let me enter into a little bit of detail into the 3 sensitivities that could potentially lead to either a positive outlook or an upgrade. The first one is a sustained decline in the debt to GDP ratio.
Okay.
We forecast that the debt to GDP ratio will significantly drop from 70%, 72%
to 60.
in 2024 to 60% in 2025, and then stabilize at this level in 2026. So a significant, a continued decline in the debt to GDP ratio path that is underpinned by strong implementation of a credible medium-term fiscal consolidation strategy would be potentially one of the triggers for a positive rating action, either a positive outlook or an upgrade. The second one that is still related to public finance is obviously related to liquidity pressures.
Okay.
So reduced liquidity pressures, so typically a declining interest to revenue ratio that is due potentially to greater confidence in reform implementation and in continued restoration of macroeconomic stability in Ghana would lower debt interest costs and would lower this interest to revenue ratio that is a key rating constraint for Ghana so far. And the third one is related to external finance. We do consider that there is a very positive momentum in the external finance metrics with Ghana. So typically Ghana has shifted to a current account surplus, which is a very significant shift compared with pre-default large sustained current account surpluses. And this shift to current account surplus would, in our forecasts, enable Ghana to increase the level of international reserves up to about 4 months, exactly 3.9 months of current external payments, but this is still below the B median of 4 or 9 months, let's say 5 months. So a sustained increase, a sustained buildup in international reserves that would comfort the external liquidity of Ghana and that would support Ghana's ability to meet its external debt service payments would potentially trigger a positive rating action.
And if you look at these three factors, am I right to suggest that your projections say they are all trending positive, at least in the medium term? Am I right to suggest that?
Well, regarding external finance, we forecast an increase in reserves, but still below and somewhat far below the B median. So that would not, so far, our forecasts would not trigger a positive rating action.
Okay.
So Ghana would need to outperform our forecast to trigger this positive rating action. Then, as regards to a sustained decline in the debt to GDP ratio and a declining liquidity pressures, well, so far we forecast that the debt to GDP ratio will stabilize at 60% in 2025 and 2026, and the interest to revenue ratio would stabilize at 25-26%. Over the medium to longer term, we forecasts that the debt to GDP ratio will gradually decline to about 56% by 2029, but that's a very gradual declining path that would not necessarily trigger a positive rating action.
Okay. That's an interesting point. I mean, he's given us the three indicators. So should we? So I guess the point of question on that analysis. Am I fair to then conclude that we should not be expecting a positive rating or another upgrade anytime soon until these key indicators are met in the medium to long term?
Yes, I mean, if one or more than one of these conditions is met, that would potentially lead to a positive rating action.
Okay, so that's an important point. So you don't need all three to be met for you to trigger a positive rating action.
No, it's either individually or collectively.
Okay, so that then leaves room for us to expect that if at least one, and some of them we're doing very good, and you projected that we'll continue to do.
We have exceeded the target.
Yeah. And
two of them, we have actually exceeded the target. If you look at the debt to GDP ratio, we are doing better and far ahead of the threshold under the debt sustainability, under the IMF supported program. Then again, if you look at our external balance, we're
also doing. So 2 out of the 3.
So actually, if you look at the dynamics, I think the challenge with the rating agencies over the years is that we struggle to move up appropriately on the upper end. Okay, when you are moving from the investment grade and upper.
I think when you're getting to the upper end of it, there is this generic metrics, right, which is not favorable to emerging markets as far as I'm concerned.
Which one is that?
No, that's a generic. Yeah, regardless of who is in power.
Yeah.
I mean,
he's using fine language.
I remember you saying that it's a case of whether we should, or I'm not saying we should form our own ratings agency, but what I'm just saying is, like, you know, they are generic metrics getting to the tail end, you know, at the upper end of it, which we really need to recalibrate to have emerging markets reflect.
Could you, and I'll come to Prof. Could you?
You see, I am of the view, and I think if you look at the trends in other markets, that for these, in fact, if you look at their own formula, we should actually be scoring better than
a B minus.
Yes, we should be scoring better than this. But the reality is that there are jurisdictions that will score higher for the same numbers that we are performing than us. It's a reality that we have.
And Prof, hold on, let me put that to Thomas. Thomas, how do you respond to that?
Sorry, I beg pardon?
Sorry, I mean, my guest in the studio was making the point that if you look at your own metrics, we should be scoring far higher than the B minus currently. And that feeds into the concern that some African governments have had, our own government have had, that there is some inbuilt, use the word bias, if you like, in the way Fitch and other ratings agencies sort of rate African countries. What's your response to that?
Well, rating agencies are based on criteria that is in the public domain, and we use exactly the same criteria, whatever the sovereign is. So typically in the case of Fitch, we have what is called a sovereign rating model that gives a predicted rating outcome, and then we can adjust by plus or minus 3 notches from this sovereign rating model, using some fiscal metrics, some external finance metrics, some structural metrics like governance indicators that are provided by third parties, using GDP per capita. So whatever the sovereign is, we are using exactly the same methodology. So there is no particular bias in favor of advanced economies or against emerging or frontier markets. We're, again, using exactly the same criteria, whatever the sovereign is.
Prof, you think you make the point that you're actually expecting us to be more than B minus?
Yeah, if you look at the dynamics and the formula, if you look at in terms of structural issues, we've made considerable progress under the IMF-supported program, the Fiscal Responsibility Act, the Fiscal Council, and all of that. Then again, if you look at economic performance, if you look at we have exceeded the target consistently. Actually, if you look at 2024, across all the quarters, I'm looking at it vis-a-vis the IMF-supported program and the target. Then again, if you look at external balance, you can see, as at the end of actually October 2024, we had reserves far in excess of the threshold. And I've said that if the previous governor wanted to push the exchange rate to 10 Ghana cedis, they could have done it.
But he actually said it publicly at the time that he could bring it to 10 cedis. Yeah. But then, it's a matter of sustainability.
Could you raise, because of time, happy with the explanation you got from Thomas?
Well, it's not an unexpected explanation. But I think that there's also some credit we can give them for why, sometimes when we get to the upper bands, we don't move quickly. It's a question of, in my view, our or the credibility of our economic performance. If you look at even this report that they've issued, they are beginning to signal that there are a number of parameters that we are going to perform worse than we have projected. And I mean, I've been speaking to some of my friends who are in government that, listen, if this continues consistently, it will undermine the credibility of your forecast. So that now when you do a program, they won't look at it and say, based on that, we're upgrading it. But quickly, I think in the end, a few things they should keep an eye on are the commitment controls. I think they've made some efforts there, but it is one of the things that undoes a lot of governments. They need to go back to pay attention to PPPs, because you can't fund all your promises from the Treasury, and you need to find ways that you can do that. Once again, keep an eye on the revenue picture
as well.
And deal with hidden debt.
Yeah, I have to,
a lot of
wrap
hidden
up.
debt.
We go off
I mean, for me,
automatically.
that's all of what we are preparing ourselves
to do.
Because if we don't prepare ourselves to have that stability, financial muscle,
Kali, thank you.
Headroom,
Kojo, I'm grateful. Prof, Thomas, thank you also for joining us from Fitch. He's the director for Middle East and Africa Sovereign Ratings at Fitch. I'm grateful that you could all join us on this.